Our focus on results. It was Mindspace REIT that reported a good first quarter number. Revenues were up 26%. To discuss the road ahead, we're now being joined by Ramesh Nair, the MD and CEO at Mindspace REIT, to discuss the road ahead for the company. Ramesh, good afternoon. Thank you for taking out time. Your distribution per unit this time around grew 15.2% from last year. What's your target for FY27? And how is the leasing landscape looking like currently? And how is it likely to pan out going for the rest of the year?
Thank you for having me on your show. DPU went up 15%. One interesting aspect is over the last 4 quarters, we've been giving double-digit DPU growth. This quarter, like I said, was 15%. Before that, again 15%. And 2 quarters before that, 13 and 10%. So we typically don't give guidance. But given that we've been doing a lot of development, in our portfolio, we have around 6.6 million square feet of under construction, of which around 4.7 million square feet is due this year, and most of that is already leased. All this will have a direct impact on NOI and on DP.
Okay, Ramesh, that's very good to hear. So, significant addition as far as leasing space is concerned, and you're expecting quite a bit of it to be operational. Give us a sense of the occupational leasing trends. So, number one, last quarter we understand it was at close to 94%. Has there been any uptick or downtick over there? And going forward, what are the kinds of trends that you're seeing, especially given the fact that some of the newer places that you are onboarding may see slightly lower trends?
So our current numbers, occupancy numbers, are at 95.8%. This is the highest we've been. The absorption in all the markets, the 4 markets where we are present, the absorption numbers have been phenomenal. Last 3 years, actually, we've seen all these markets across the country, the absorption numbers grew at 18%, 16%, and 15%. And I was just checking the net absorption of the first 6 months of this year, where again, the market has gone up 12%, in spite of all the macro and geopolitical issues we have had in the first 6 months. So another good data point, which I saw recently, was the relevant vacancy today, which is like good quality space. Out of India today has around 950 million square feet of office space. In that relevant stock, the relevant supply is around 530 million square feet. In that 530 million square feet, the relevant vacancy is at 9.9%. And in cities like Bombay, this is last 15 years, this has been the lowest, the vacancy numbers. Everyone knows about the GCC story. Today, GCCs have around 40 to 45% of the demand in the market. So we've been beneficiaries of all that with the right product at the right time in markets like Hyderabad, Pune, Navi Mumbai, and Chennai.
Okay, Ramesh, take that point completely on board. A couple of quick questions. Number one, when you speak about GCCs, we understand growth there has been quite strong, but we also understand that addition as far as, the traditional IT services has been quite muted. So has that offset each other, or will you be net positive on account of demand coming in from the IT versus the GCC? And number two, give us a number as to how much operational capacity you will be adding this particular year, and what could be the occupancy at the end of the year?
So from a GCC point of view, today our tenant profile, if you break it up, 53% is GCCs. Foreign MNCs are at around 18%. Domestics at around 27%. And overall, if you look at IT services, both from the foreign point of view and the Indian point of view, that's a 9 plus 9%, which is around 18% of our portfolio is towards IT services. One very interesting trend I have seen is in the last 1 year, we've actually seen many IT services companies come and take space with us. And I was wondering, when the net headcount has not been growing, where is this demand coming from? So 2 things we have realized. When the IT services companies are pitching for GCC kind of work, global work, there's a lot of decision making internationally where those clients want to be in the main cities, want to be in grade A campuses. That's helping us. Secondly, previously, IT services companies would typically go to their own campuses, They would go to tier 2 cities or be in far-flung locations within the bigger cities. Today, that's changed because given the pace at which all industries are changing, they're looking for ready-made space which they can occupy in 3 to 6 months. So both those things are definitely benefiting us. Definitely, the growth rates of GCCs are much higher. Previously, our portfolio used to have around 25 to 27% IT services. Today, that's dropped to around the 18% mark.
Ramesh, pleasure having you today. Thank you so much for sparing time and joining us on the show. Wish you good luck for the rest of the year as well.